There's a real shift underway. Since 2021, spending on new factories in the US has nearly tripled. Companies are investing heavily in building things closer to home, partly to avoid the supply chain disruptions we saw during COVID. At the same time, government programs like the CHIPS Act and Infrastructure Act are helping fuel that growth, and the US still has a big advantage with relatively low energy costs compared to places like Europe and Asia. But it's not a perfect comeback story. Not all manufacturing is returning to the US. A lot of it is simply moving closer, like to Mexico. And even when new factories are built, they don't always create a lot of jobs. Because automation and robotics are doing more of the work, there are also some cost pressures. Tariffs can raise expenses for companies that still rely on imported parts. And over time, rising energy demand could shrink the US's cost advantage. So what's the bottom line? This is a real manufacturing revival, but it's partial, not a full reversal of globalization. The biggest impact is showing up in increased spending and production capacity, especially in areas like technology and electrical equipment. For investors, that means the opportunity isn't broad, it's selective. The key is focusing on companies tied to US infrastructure, energy, and manufacturing investment, rather than global industrial trends. As always, positioning matters. And that's where thoughtful portfolio strategy comes into play.